Act 1881 and Indian Contract Act. So, very good morning, one and all. So today, let us start with Negotiable Instrument Act. Let us see the important aspects of this particular act. And after this, we will also go through and have an overall view about the Contract Act. Okay. So this act is important, as I have already mentioned in the last class. We have just seen the introduction of the NI Act, which is applicable to whole of India. And the three important instruments of negotiable instruments are promissory note, bill of exchange, and check. The rupees and coins will not fall under the definition of negotiable instrument. Okay, negotiability means transferability. Instrument is a document having value for it, and it can be transferred and number of times, which we have discussed in the last class. Okay. The term hundis, if it is not guided by the local customs and practices, then NI Act is applicable to the hundis, which is the old concept. Okay, and it is freely transferable from one person to other person, having some value to it, and it is free from defects. Are few of the characteristics of negotiable instruments. And the person who takes a negotiable instrument in good faith for consideration before maturity is termed as holder in due course. Generally, the term holder in due course is applicable to the person who takes the instrument in good faith for consideration and before maturity. Okay, so these all are important characteristic features of a negotiable instrument. So as we all know, in these three particular cases of promissory note, bill of exchange, and check, bill of exchange and promissory note can be called as a stamped instrument, where stamp will be applicable to it. But in case of a check, the stamp, we cannot attach any stamp to it, so it is not a stamped instrument. Okay, so we have discussed in the last class who are the parties of a promissory note, bill of exchange, and check. All three instruments should be mandatorily in writing. Writing is compulsory. Promissory note, the bill of exchange, and check, without, they can't be oral. Negotiable instrument should be in writing. It's an instrument in writing containing an unconditional order. There should not be any such conditions before the like preparing a promissory note signed by the maker to pay certain sum of money only. Here only money is paid. You cannot accept any value for kind or any consideration in form of kind. Okay, payable to order or the bearer of the instrument. Okay. Here, as I have already yesterday told you, in case of a promissory note is executed or is prepared or is drafted when one person accepts some loan amount from any other person or a financial institution. Okay, so promissory note is prepared when one person accepts a loan or any kind of consideration from other person, and the promissory note is executed between them. The person who is borrowing the money is called as a debtor, and he is the maker of the promissory note. The person who is lending the money or giving the finance is called as a lender or a creditor or a payee of the promissory note. Therefore, maker prepares the promissory note, signs it, and gives it to the payee, who is in turn called as a holder of the promissory note. Next, in case of a bill of exchange, you have here two parties, and initially, then afterwards three parties. Like, what are those two parties, ma'am? It's a transaction which takes place between the buyer and the seller. The buyer who purchases goods on credit is called as a drawee, and the person who sells the goods on credit basis is called as a drawer. Okay, the seller will prepare the draft the bill, specifying the contents like the value for which the goods are sold, the interest rate, and the time after which the payment would be made. And the buyer would accept that particular bill and give his acceptance by signing on that particular instrument. Therefore, drawee's signature, that is buyer's signature, is important on the bill of exchange. And after signing that particular instrument, that bill is again given back to the drawer who holds the instrument. He can hold the instrument until the due date, or in between, if he is in need of money, he can transfer the instrument or endorse the instrument by signing behind it as an endorser and transferring to other person who is called as a payee of the instrument. Therefore, in case of a bill of exchange, there are three parties: drawer, drawee, and payee. Okay, so we have seen all these cases in the last class, and I have also told that qualified acceptance, when this particular qualified acceptance occurs in case of a bill of exchange. In case of a bill of exchange, at the time of a due date or before due date, when the holder of the instruments present the instruments to the drawee, asking him whether he would make the payment or not, that is called as presentment for acceptance. Okay. Therefore, in such cases, a drawee should not give any kind of, he should not keep any kind of conditions. If he keeps condition, then it is called qualified acceptance or conditional acceptance, which should not be, that such qualified or conditional acceptance should not be accepted by the holder. If holder accepts to such qualified acceptance, what would happen? The prior parties would be discharged from the liability. Therefore, only drawer would be liable to the holder. Therefore, what the Negotiable Instrument Act is saying, Negotiable Instrument Act is saying for the holder not to accept for the condition of the drawee, then he need to dishonor the instrument, give the notice of dishonor to prior party, and make them all liable on that particular instrument. Okay, so this is the meaning of the qualified acceptance in case of a bill of exchange, and what's the remedy available for the holder. Okay, so we have also seen the difference between promissory note and a bill of exchange in the last class. Now let us come to the check. Check is very important part of a negotiable instrument, which also facilitates for our credit rating. Generally, checks are always payable on demand. Therefore, check is called as a demand instrument. It is not a time instrument. Okay, check is not a time instrument. It is a demand instrument. In case of a check, yesterday I have briefly have told you there are three parties in case of a check. Who are those three parties? Drawer, drawee, and payee. Generally, check is used for the purpose of making payments, right? We all know that we use this particular check for the purpose of making payments. Okay. Fine. Generally, the person, for the purpose of making payment, he takes this particular check which is given by his bank where he maintains his account, and he mentions the person to whom the payment should be made. This particular pay column, that person's name is Sir X or so and so, he'll write and specify the amount in which he have to, which he have to pay. So specifies the amount in words and in numbers form also, and gives his signature. Therefore, the person who is preparing, giving signature on the check or making payment is called drawer of the check, and the person to whom the payment should be made is called, the creditor is called as a payee of the check. Then who is drawee, ma'am? Drawee is nothing but a banker or a paying banker who makes the payment on behalf of a drawer when the payee presents the check. Okay, when payee presents the check, the drawee, the paying banker, he is also the bank of that particular drawer where he maintains the account, will make the payment to the payee. Okay, so these are the three parties in case of a check. Check is also a kind of a bill of exchange drawn on a specified banker, generally payable on demand. Generally, check can be a physical check or electronic form of check. Okay, the electronic form of check is nothing but it will also exactly look like a mirror image of the check. There you don't have any physical check, you will be given a digital signature. The customers of the bank who maintains electronic checks will have a digital signature, because when he is busy with his business works or when he's on continuous travel, in such cases he can issue these electronic checks to his creditors or for whom he need to make the payment. Okay, next one is, as I have already told, drawer, drawee, and payee in case of a check. So these are the general difference between bill of exchange and check card. Bill of exchange, in case of bill of exchange also you have three parties. In case of check also you have three parties. Bill of exchange is payable on demand as well as it is a time instrument, but check is always payable on demand. So since the bill of exchange is a time instrument, 3 grace days are added to that particular, after calculating the due date, 3 grace days are added. But in case of a check, since it is only a demand instrument, it is not a time instrument, the 3 grace days are not required. In case of a bill of exchange, before making payment, acceptance is necessary from the drawee, but in case of a check, there is no such specific acceptance. Okay, so these are few. Stamping is required in case of a bill of exchange, it is not required in case of a check. Okay, so these are few points relating to the check and a bill of exchange. Now, let us come. What are the different classification of a negotiable instruments? On what basis these instruments have been classified? Important. There are order instruments, bearer instruments. The classification of negotiable instruments are of following types: order instruments, bearer instruments, demand instrument, time instruments, and you have inland instruments and foreign instruments on the basis of location. So these are few types, and you have other categories also. Ma'am, what is an order instrument? Specifically on the negotiable instrument, if you expressly, the person who wanted to make a payment expressly write, pay the contents of this particular instrument to so and so person on his order. If he specifically write and transfers the instrument, that is called as an order instrument. If there is no express payment, I mean person to be paid, and if they specifically leave that particular that column or the place as a blank, then it is called as a bearer instrument. Okay, it is generally payable on bearer. We can just give for example, bearer checks are those checks where suppose an employer uses a check without specifying a name and just mention the money and give his signature. In such case, we can take that particular check and cash over the counter. Those are called as bearer instruments. Next, demand instruments. Check is always demand instruments, and bill of exchange or promissory note can also be demand instrument when time is not specified on the instrument and specifically they mentioned on that particular instrument that it is to be paid on demand. Once you show that instrument to the principal debtor, he will make the payment. Okay, so for example, in case of a check, once you take the check from your debtor, the creditor goes and encashes it in the bank by showing that particular check. That is why it is called as a demand instruments. But in case of a time instruments, when on the face of the instrument or on the specifically on the instrument, if they mention that it is payable after a specific period of time or after a certain period or after sight or on happening of specific event, in such case it is called as a time instrument. Due date is calculated accordingly, and once you calculate the due date, you will add 3 days grace date according to the provisions of Companies Act. So 3 days grace days are applicable only in case of a time instrument. Okay. Then now when it comes to on the basis of location, there are two types: inland instruments and foreign instruments. When you will say that particular instrument as an inland instrument, means you have to satisfy these two conditions, then only you can call this particular instrument as an inland instrument. What conditions you need to satisfy? When the instrument is drawn or made in India and made payable in India, and it is in first condition, when the instrument is drawn in India or made in India and made payable in India. Okay, so when the instrument is drawn in India or made in India and made payable in India, or when the instrument is drawn in India or made in India and drawn upon a person resident in India. If any of these both conditions are satisfied, then you can call it as an inland instrument. Okay, otherwise it will be treated as a foreign instrument. Okay, so what is an example, ma'am? What is an example for an inland instrument? So let us see an example for an inland instrument. So before going for an example of suppose a person who is in India, who is in Bangalore, draws a bill on Mr. X, who is in Pune. Okay, so and it is made payable in California. Now tell me whether it is an inland instrument or a foreign instrument, because a particular person is in India and he is drawing upon a person who is accepting that particular instrument even in India. Then in such cases, that instrument is called as an inland instrument because it is drawn or made in India and made and drawn upon a person. The second criteria, drawn upon a person who is resident of India. Therefore, it is valid. It is an inland instrument. Okay. Now another example: a bill drawn in London on a trader in Chennai and accepted payable in Chennai. Okay, so here they are specifically taking that a bill drawn in London, which is not in our country. Therefore, the first criteria itself is not being satisfied. Therefore, it is called as a foreign instrument. So, in order to decide whether the instrument is an inland instrument or foreign instrument, you need to satisfy these conditions. Then only you can say that the particular instrument is inland. For inland instrument, it should be either drawn or made in India and payable in India. Any of those both conditions are mandatory. Otherwise, drawn or made in India and drawn upon a person in India. So these conditions are necessary for satisfying as an inland instrument. Next. Ambiguous instrument. Ambiguous means, suppose initially when the instrument is drawn as a bill of exchange, and later when it is endorsed, it can be treated as a promissory note. In what situation, ma'am? So, for example, if a seller is drawing a bill on a specific buyer who is a fictitious person, here buyer is a fictitious person, and he signs in that particular bill is also signed by some other person, and if that particular seller or the drawer endorses the instrument, the endorsee or the holder of the instrument can treat it as a promissory note. That is why this is called as an ambiguous instrument. It might be treated either as a promissory note or bill of exchange later on by the holder of the instrument. Next, very important for the practical case law is the in-short stamped instrument, which is very, very important from the practical perspective. What is this in-short stamped instrument? It is called as an incomplete stamped instrument, because on this particular instrument you will not specify the amount. Okay, the amount is not specified on the instrument, but you will stamp it. The instrument will be stamped, and the stamp will be having certain value. Okay, when a particular maker of the instrument who makes the promissory note without specifying that how much amount is due to that particular payee or the creditor of the instrument, he attaches a stamp which is a value of around 50,000, and he borrowed a loan amount of 30,000. Okay, in this particular case, the maker had borrowed, that is the debtor had borrowed 30,000, and he attached a stamp of 50,000, and he signs the instrument without specifying the amount to the holder of the instrument, that is payee. Now tell me, on the due date, payee, how much amount he should write in that particular instrument? He should write the amount which he have taken as loan plus some interest amount. But in this particular case, the payee have wrote the entire 50,000 amount. Now tell me, as the holder of the instrument, can payee claim 50,000 from the maker? Yes, because it is the amount which is covered by the stamp, he can claim. Suppose instead of 50,000, if he writes amount around 60,000 rupees, that amount can't be claimed. It is because it is above the stamp value, which cannot be claimed. So what the act says is, what the NI Act says is, the holder of the instrument can claim maximum to the extent of the value of the stamp in case of in-short stamped instrument. This is a privilege given to HDC, who takes the instrument in good faith for consideration before maturity. Okay, next, accommodation bill. What is called as an accommodation bill? A bill is said to be an accommodation bill when one party is accommodating other party or helping other party to raise funds, okay, without any consideration. Therefore, this is also this is called as one type of bill of exchange, where the drawer, the seller of that particular bill, in order to help his friend for the purpose of raising money, even though there is no transaction, no sale transaction between him and his friend, he creates a fictitious bill. Who is creating a fictitious bill here? Drawer is creating fictitious bill for the purpose of helping out his friend to raise the amount, whatever he needed for the business purpose. So here, a fictitious bill of 5 lakh rupees have been prepared by the seller, Mr. X, in favor of his friend, Mr. Y. Okay. Now, this particular instrument is signed by Mr. Y, and later on, Y can use this particular bill for raising his funds or for borrowing loan either from financial institutions like banks, or he can endorse this instrument to other party or financial sound person, where he gives some consideration to Mr. Y. So at the time of due date, now tell me, it is whose responsibility to make the payment? It's a responsibility of Y to make the payment to the holder of the instrument or to the bank. If Y fails to make the payment, then who will be liable to make the payment? The drawer who helped or who accommodated the Mr. Y for the purpose of raising his funds. Okay, so even here there is no consideration, but X helped Y, and if Y fails to make the payment, X is liable to make the payment, and therefore X, after making the payment, he can file a case against the Y in the court of law and claim the entire money from Mr. Y. Therefore, what here X have to mention? X should clearly says that in their agreement that he is accommodating Y for the purpose of raising funds, even though there is no consideration between them. So this is an example. This is a general meaning of an accommodation bill. Now, at the time of calculation of maturity of negotiable instruments, that is nothing but time instruments. Only bill of exchange and promissory note are time instrument. So we will calculate maturity dates for bill of exchange and promissory note, but not for checks. The total validity period of check is 3 months. After that, it will expire. Okay, the validity period of check is 3 months. Maturity is nothing but the due date on which the payment have to be made. Okay, when we calculate this maturity date, in addition we add a 3 days grace period to calculate the date of maturity. 3 days grace days are added to the period stated in the instrument. Okay, then you will get the due date. So this is a general example. Suppose if the maturity date is falling on a public holiday, then you should take the preceding date. Once you calculate, then the maturity date is falling on August 15th. Then you will take the due date for the purpose of payment is August 14th. It is falling on 26th January. Then you should take 25th January. Otherwise, suppose if the maturity date is falling on a day which is declared as an emergency holiday, which was declared as a sudden holiday, then in such cases you will take as a due date as a next succeeding day. Okay, so these both points are very important. Suppose when you after calculating the due date, the date was a sudden holiday, then you should take the next succeeding date as the due date. Okay, so these are few examples related to the calculation of maturity days. And suppose there is another point. Can these negotiable instruments drawn in installments, can they be payable in installments? Yes, they can be payable in installment. And for calculating the due date for each and every installment, we will add an additional 3 days grace days for payment at the time of each and every installment. So these are few examples where you can calculate the maturity dates. Okay, next one. Who are generally different parties? Generally, in case of negotiable instrument, we have seen in case of promissory note, bill of exchange, and check. Generally, the person whoever holds the instrument is called as a holder of the negotiable instrument. But I told no, for the conditions to be satisfied in case of holder in due course. In case of holder in due course, if he takes the instrument in good faith for consideration before maturity, then he becomes a holder in due course. Okay. He must take the instrument for consideration before maturity, and he should act in a good faith. And now next are very important aspects are the privileges, special privileges. What are the advantages of holder in due course? If he is a holder in due course, when the instrument gets dishonored, he can make all his prior parties liable on that particular instrument. By giving a notice of dishonor, all the prior parties would be liable for that particular instrument. And once the instrument reaches to the hands of HTC, it will be free from all the defects, even though in between the instrument have been transferred fraudulently, but once it reaches to the hands of HTC, he will get a good title. And when the instrument is being transferred on conditions also, such conditions will not be applicable when the instrument reaches to the hands of HTC. However, in case of an insured stamped instrument, the HTC can claim the entire amount to the value of the stamp. Even though the due amount is lesser than the stamp value, the holder in due course can claim the entire value of the stamp in case if he is a HDC. Okay, so these are few important privileges. If the instrument is obtained for unlawful means or unlawful consideration, but once it reaches to the hands of, after the number of endorsements, if it reaches to the hands of HDC, he will get the instrument in good faith, and he will get the instrument for consideration in good faith. Therefore, he can claim the amount from the principal debtor of the instrument. Okay, so these are the extra privileges which are available to a holder in due course, but these are not available to just a holder. Okay, now capacity of parties. Can a minor be a principal debtor in case of a negotiable instrument? Can minor be a can enter into a contract? No, according to the provisions of Indian Contract Act and NI Act, a minor cannot be a party liable on the instrument to make the payment to the holder. However, minor can draw or endorse, but he will not be treated as a party liable on the instrument. He can be the holder of the instrument. And in case of person of unsound mind also, similar meaning is applicable. Okay, now in case of an agent, on behalf of any endorser or endorsee, agent can transfer the instrument and he can act according to the principle, but agent cannot sign the instrument. If he signs the instrument, he will also become person liable on the instrument. Okay, in case of a legal representative, deceased person who will sign his promissory note or bill of exchange will be personally liable to the extent of assets received by him from the deceased. This is very important point you need to remember. Okay, in case of a legal representative, if he signs a promissory note or a bill of exchange, in such cases he will be liable only to the extent of assets received by him from the deceased person. Okay, so these are, if an agent signs the instrument, then what will happen? He will also become a prior party and liable to make the payment on the due date. Okay, so these are few points, important points in case of a negotiable instrument. Now let's see what is a negotiation. Negotiation is nothing but a transferability, what I have already told you. Once the promissory note bill of exchange is prepared, it is given to the holder, and if the holder wants, he can transfer n number of times until he receives the payment. Okay, so what is an assignment? Assignment is nothing but transfer of ownership of a negotiable instrument through a written or registered document according to the Transfer of Property Act, and the transferee will become the owner of it. Okay, so this is the general difference between assignment and a negotiation. Okay, in negotiation, when you when it is being transferred, sometimes it may happen a blank transfer also. You need not specify the name of the endorsee, and consideration is always presumed. Here consideration must be proved. Okay, in case of an assignment, there is no blank transfer. You should specifically mention the name of the transferee or assignee. Okay, so these are few differences between negotiation and assignment. Now next, very important in case of check, this particular part is important in Negotiable Instrument Act, because they will ask you either for practical question or from the theoretical perspective. Okay, why we need to do crossing on checks? By crossing over the checks, what are the advantages available for the purpose? Why? For the purpose of crossing on this check. Crossing is nothing but it is an additional security given to the check. If once the check is crossed and give it to the holder, if the drawer cross the check and give it to the holder, it means that the payee or the holder of the check cannot encash over the counter of the bank. He compulsorily should go to his bank and deposit in that particular bank, and the amount will be credited to his account after a few days. Okay, in case of a crossed check, it's a security to ensure that the amount has been properly credited to the right account. Okay, therefore the payee or the holder cannot encash it once the check is crossed. He need to go and deposit in his account, and amount will be transferred from debtor's account to be debited and credited to the creditor's account. Okay. Therefore, who can do crossing, ma'am? Crossing can be done either by the drawer or by the payee or the holder of the instrument. Once the check is given to the holder to ensure its security, it will be drawn even by the payee also. Payee can also draw that particular check as crossed check. Okay. Now, how many types of crossing are there? Very important kinds of crossing: general crossing, special crossing, account payee crossing, and not negotiable crossing. These are different kinds of crossing. Okay. What are different kinds of crossing are? General crossing, special crossing, account payee crossing, and not negotiable crossing. General crossing is, it's nothing but like, see here how we draw two parallel lines, or writing between two parallel lines and writing account pay. All this is a general crossing, where generally it is in practice by the businessman. Okay, in case of this general crossing, the person whoever crosses checks and hands over to the payee or the holder, he can take that particular check, go to his own bank and deposit the check, and it might be credited to his account within 2 days, 3 days, depending on that particular working days of the bank. Okay, now next, in case of other than general crossing, special crossing. In case of special crossing, what will happen here? Specifically, the drawer of the check will mention a bank name. The bank name is mentioned in this particular special crossing. The main purpose of mentioning the bank name in the two cross lines are two parallel transfer lines, which should be drawn only at the top left corner of the check. And here one more point: you cannot draw this parallel transfer lines at any other place except on the top left corner. The main purpose of the special crossing is it prevents fraudulent transaction. It is a direction to the paying banker to pay the amount to the account holder of that particular bank only, but not to the other bank. Okay, it's a direction to the paying banker to pay the amount only to the account holder of that particular bank, but not to any other bank. If the check is specially crossed on a particular bank, and if the check is presented in another bank, the paying banker will refuse the payment. Suppose the paying banker is, suppose I am having a check. I am having an account in HDFC Bank. I gave a HDFC check to Mr. Y, for whom I need to make the payment. In such cases, if I specifically mention in those two parallel lines the name of the bank SBI, then the holder of the check should have account in SBI bank. Only then the amount will be credited in his account. If he's having check in some union bank, he cannot get the amount credited to the union bank. Okay, he should get the amount credited only to the SBI bank. Okay, which the name of the bank where I specified in that particular two parallel transfer lines. Okay, this is an important. And as of now, the special crossing is not much prevalent in the business practices. General crossing or account pay crossing is only more prevalent. Okay, so this is an example for special crossing. Next one is account pay crossing. This is a very famous and this is much in practice. Account pay crossing is one of the secured way of crossing. It has developed in the trade and common use the terms on the left side of the check between the two parallel lines. Generally, account pay is nothing but for whom you need to give the payment, that person's to that particular person's account only the amount will be credited. The check would be valid only when the amount credited to that particular person's name whom you have mentioned on the check. It is only in form of direction to receiving bank that the drawers decide to pay the particular check into the bank which keeps the account of the pay. The collecting banker should credit the check only to the mentioned account of the payee. Okay, whosoever name is specified on the check, to that particular person name only the amount will be credited. And on in between the two parallels, you will write account payee as in between words account payee, and you will also mention the name of the person to whom the amount will be paid. Okay, so these are the examples of account payee check, which is one of the safest form of crossing of the check. Next another important form is a not negotiable crossing. Here, not negotiable, if when you see this particular term not negotiable, it does not mean that it is not transferable. Okay, if you specifically mention the words not negotiable, it does not mean it is not transferable. Here, not negotiable means what? In this particular case of not negotiable crossing, you need to, understand few important points. Okay, just I'll have 1 minute break and come back. Okay. Okay, sorry for the interruption. In case of not negotiable crossing, generally what happens is, if suppose a drawer of the negotiable instrument, if he specifically mention the words not negotiable in between the two parallel lines, it means that during the course of endorsement or when the instrument is transferred from one person to other person, if anybody takes the instrument by fraud or by unlawful means, in such cases the instrument would become void in their hands, and he will not, and if suppose even though the amount is credited to his account, the amount will come back to the original drawer of the instrument. Okay, to the original, the amount will be amount will not be transferred to that particular person who took the instrument in unlawful ways and means. So it ensures the not negotiable will ensure that amount is correctly transferred to the person who is live. I mean, like who for whom the amount is need to be paid. The objective of that particular crossing. Okay, it gives more protection and safer to the holder of the check. The third person cannot encash when the check is marked not negotiable. Okay, it can also be transferred like any other check. The transferability can be done, but it will transferred only to the right person. If it goes to the wrong person, you can claim the amount back. Even the collecting banker should transfer the amount to the paying banker if it is transferred to the wrong person's name and to his wrong account. Okay, this is a benefit of not negotiable crossing. Okay, next one is crossing. Crossing can be crossing after the issue means if once the check is issued by the drawer, the crossing can be done even by the holder of the instrument. If it is crossed like in a general crossing, he can add the words account payee or not negotiable. Okay, so in such way, crossing crossing can be done either by the drawer of the check or by the holder of the check. Both of them can cross that particular instrument. I have already told you about incomplete instrument, accommodation bill. And now next one person is drawing in case of need. Who is this particular person? Drawing in case of need, ma'am. Generally in case of a bill of exchange, when the goods are sold on credit by the seller to the buyer, then seller requests the buyer or the debtor, asking him to ask to bring another person to sign on your behalf, or asking him to give guarantee of another person that you would make the payment on due date. If you fails to make the payment, that other person will make the payment. Okay, that other person is called as drawee in case of need. The other person who is signing on behalf of drawee at the time of his default is called drawee in case of need. Initially, when the bill is prepared between a drawer and the drawee, that is seller and the buyer, and once after the buyer signs the particular instrument, drawee signs, there's another person who will sign on that instrument, who is called drawee in case of need. He is nothing but an additional drawee who will sign on the instrument. The main purpose of this particular person is when the instrument is dishonored or when drawee fails to make the payment, then drawee in case of need will make the payment, will accept the bill and make the payment. Okay, so he is said to be drawee in case of need. So we have seen what is an incomplete instrument, what is an ambiguous instrument, who is drawee in case of need. These are few important aspects relating to the negotiable instrument. The next very, very important aspect of negotiable instruments are endorsement. What is the meaning of an endorsement? Endorsement means I have a, see, what's the purpose of preparing a negotiable instrument? Negotiable instruments have prepared which facilitates for credit trading. Okay. So, suppose if the holder of the instruments want money before maturity date, if he is in urgent need of money before maturity date, what he can do? He can endorse the instrument, right? Therefore, in this particular case, when holder of the instrument, if he want to money before the maturity date, he can endorse it to other person who will give the money for that particular exchange of a bill or a promissory note or a check. The person who transfers the instrument is called as an endorser. The person to whom the instrument is transferred is called as an endorsee. And very, very important, or either bill or a promissory note or a check, all these three instruments can be endorsed n number of times until the principal debtor makes the payment. Okay, how many times these particular instruments can be endorsed? They can be endorsed n number of times until the principal debtor makes the payment. The person making the endorsement is called endorser, and endorser's endorsement will be valid and complete only when endorser signs the instrument. Okay, so once again I'm telling you, the endorsement will be valid and complete only when the endorser signs the instrument behind the instrument. And the person to whom the instrument is transferred is called as an endorsee, and he will become the holder of the instrument. If he want, he can keep until the due date. Otherwise, he can also endorse that particular instrument. Okay. Now, types. So in this particular case, types of endorsement: there is blank endorsement, there is full endorsement, partial endorsement, restrictive endorsement, conditional endorsement, sans recourse endorsements, and facultative endorsements. Okay. So what is blank endorsement, ma'am? In this particular case, the endorser just gives a signature. He will not give the details or specify the name of endorsee for whom the endorsement is made. Okay. What will happen in case of blank endorsement? The endorser will just sign the instrument on behind of the instrument, and he will not specify the details of endorsee or give the name of the endorsee, and he will just endorse the instrument to the endorsee. This is called as blank endorsement. Okay, then what is full endorsement? When the endorser specific after signing on the instrument, if he specifically mentions the name of endorsee with all necessary details, that is called as a full endorsement. Okay, so next, partial endorsement. Ma'am, is partial endorsement valid? No, generally in the Negotiable Instrument Act, partial endorsement is not at all valid. Okay, you cannot endorse the instrument suppose the value of the instrument is 2 lakhs rupees. You cannot endorse the instrument for 80,000, or you cannot endorse the instrument for 50,000. So you cannot, and if you want to endorse, you should endorse for 2 lakhs completely. Otherwise, if on 2 lakhs, 1 lakh is paid by the debtor before the maturity date, for balance 1 lakh, if you want, you can endorse. Okay, but you cannot endorse partially the negotiable instrument. You can endorse only either completely the negotiable instrument. This is very important point relating to the partial endorsement. Next, restrictive endorsement. At the time of endorsement, when endorser signs the instrument and specifically restricts the instrument by specifically mentioning that there is the instrument should not further be transferable or further be negotiated, that is called as a restrictive endorsement. Next, conditional endorsement. If the endorser of the negotiable instrument by express words after signing the instrument specifically mentions that he will be liable to pay only on happening of certain event, which is called as conditional endorsement. He is giving some conditions at the time of endorsement. In such case, it is called as a conditional endorsement. Next, very important one is sans recourse endorsement. What is meant by sans recourse endorsement, ma'am? In this case, at the time of endorsement, the endorser is excluding his liability to make payment on the due date. Okay, sans recourse means excluding his liability. Whose liability is being excluded? Endorser liability is excluded. For example, when the instrument is transferred from A to B, B to C, C to D. In this particular case, in between B, while the time of endorsement, when after signing the instrument behind, he will specifically mention the word sans recourse or without recourse to me. It means that when the instrument is dishonored, please don't ask me for any amount. I am excluding myself from the liability. Please don't ask me for the amount. If specifically any of the endorser mentions that, it means that it is a sans recourse endorsement and he is excluded from the liability. Okay. Next, facultative endorsement. In this particular case, the endorser is wavering or losing some of the rights at the time of negotiation. Expressly give up some few rights. What are those rights? When instrument is transferred from A to B, B to C, C to D. In this case, if C makes facultative endorsement, it means that if he is specifically want to leave some rights, he will specifically mention that I am no more liable for any of the expenses during the course of endorsement. It means that he will not be liable for any sort of expenses. He's wavering that right, or he's wavering. Canceling some right to receive the notice of dishonor. When he expressly gives up certain rights, even though you don't give me notice of dishonor, I'll make the payment. In such cases, such are the examples of the facultative endorsement. So these are different types of endorsements: blank or general, special or full, partial, restrictive, and conditional or qualified endorsements. Okay. Now this is very important. Converting a blank endorsement into full endorsement. What is this, madam? Suppose when the A is the holder of the bill, A endorses the instrument in blank and delivers it to B. B endorses it to C or his order. And in this particular case, C without mentioning his name, he transfers the instrument to D as a bearer. Now, in this particular case, A have endorsed the instrument to B. B endorsed it to C. Okay. Now, C wanted to endorse it to D. Okay. Here in this particular case, A endorsed in blank to B. Okay, B, what he have done, instead of writing his instead of giving his signature in that particular blank column, he mentioned the name of C. It means that instrument have been transferred to C. In between, the instrument had made blank, but that the endorser in that particular case, we will not see the name of the endorser, as he have just mentioned the name of C in that particular blank. So like that, you can convert a blank endorsement into a full endorsement. Okay. So what is this negotiation back, ma'am? Negotiation back happens when the instrument travels in a circular motion. Okay. For example, when the instrument is traveling from A to B, B to C, C to D, D to E, and again from E to A. Then the instrument is again, who became the holder of the instrument? Again, A became the holder of the instrument. Again, if any of the prior endorsers becomes the holder of the instrument, then it is called as a negotiation back. Okay. So when again the holder of the instrument, because when the endorser of the instrument becomes the holder of the instrument, again, then it is called as a negotiation back. Okay, so this is all about negotiation. There is also very important practical question is there in combination of both negotiation back and sans recourse. Please go through them. This is important from examination perspective. They are asking as a practical question. Now, last one is what is meant by discharge of instrument and discharge of party, ma'am. There is difference between discharge of instrument and discharge of party. In case of a discharge of party, only certain party on the negotiable instrument will be discharged. But in case of discharge of instrument, the entire instrument is discharged and all parties are discharged from their liability. Okay, so in what circumstances or in what cases the parties will be discharged, ma'am? Suppose when the holder of the instrument cancels any of the liability of the prior endorsers, that particular endorser and subsequent endorsers would be discharged from the liability. Okay. Nor when of the holder of the instrument releases the liability of any of the endorsers or any of the prior parties, he and subsequent to him will be discharged. Or when the holder of the instrument giving the drawee for the acceptance of a bill for more than 48 hours, then all the prior parties before him would be discharged from the liability. These are the instances or cases where the party would be discharged. Or if the holder of the instrument accepts to the conditions specified by the drawee of the instrument, in such cases before making payment, the prior parties are discharged from the liability. Or if the holder of the instrument accepts the instrument, and if in between, if there is any material alteration takes place without the information to the prior parties, then also the instrument without the consent of the prior parties, if there is material alteration, all the prior parties before him would be discharged from the liability. And in case when the instrument is negotiated back to the endorser himself, in such cases, the intermediary parties between the transaction of the circuitry motion, the parties would be discharged. In all these instances, only the parties are discharged from the liability, but not the instrument. The instrument will be discharged only when the principal debtor makes the payment. Principal debtor of that particular instrument makes the payment. Only in that particular case, the instrument will be discharged. Okay. By any operation of law, in case of insolvency of the principal, in case of insolvency of any of the prior party, such cases the instrument will be, party will be discharged. So these are the instances or cases where the party will be discharged by cancellation, by release, by allowing the drawee more than 48 hours, by qualified acceptance, by material alteration, negotiation back, and by operation of law. Then what is meant by discharge of instrument, madam? As I have already told you, discharge of instrument means in this particular case, when the principal debtor makes the payment, when the primary party liable on the instrument, if he becomes a holder through negotiation back, or if he makes the payment, or if he releases the prior parties, in such cases the instrument will be discharged. Only when the instrument is discharged, all the parties of the instrument will be discharged from the liability. Okay. Now, next important concept in the Negotiable Instrument Act is material alteration. What is meant by material alteration? From the word itself, we can say material means important alteration. If any important alteration had made in the negotiable instruments during the course of endorsement without the permission of any of the prior parties or without the consent of the persons who made the instrument, in such cases, the instrument would become void in the hands of the holder of the instrument. Okay. So if material alteration, if they alters or attempts to alter the character of the instrument, it will affect the contract. Examples of material alteration regarding the date of the instrument, regarding the time of the payment, and regarding the place of the payment, regarding date, time, and place. Suppose if there is any mistake of mentioning the year in the negotiable instrument, so instead of mentioning 2022, they mentioned 2021. In such case, that alteration can't be termed as a material alteration according to the provisions of Negotiable Instrument Act. However, any alterations regarding the date of instrument, time of payment, place of payment, and amount, if it is altered without the intimation of the prior parties, then it is termed as a material alteration. However, eliminating the words or order from the endorsement, or converting where an instrument to an order instrument, or adding the words on demand, in such cases, that is not called as a material alteration, which does not have any impact on the instrument. Okay. So, fill in the blanks of an incomplete instrument, converting blank into full, crossing of checks, these all are not called as a, they are not called as a material alteration. Once the instrument is materially altered, it becomes void against all the persons or parties who had made the alterations or who have endorsed the instrument. Okay. So now what is called as dishonor? This is applicable only in case of bill of exchange, where the holder of the particular instrument presents the instrument before receiving the payment for the acceptance of the drawee. In such cases, the drawee is given only 48 hours for the purpose of accepting whether he would make payment or not. And if it takes more than 48 hours, immediately the holder of the instrument should dishonor the instrument. If the drawee takes more than 48 hours for the purpose of accepting the bill, or then in such cases the holder should dishonor the instrument and give notice of dishonor or notice of dishonor by non-acceptance to the prior parties. Or for the purpose of presentment of the bill, if the drawee is not found after reasonable search, or if drawee becomes an incompetent person, in such cases also instrument becomes dishonored by non-acceptance. Remember one thing, and if the instrument is dishonored by non-acceptance, what the holder have to do? The holder should prepare the notice of dishonor and give this particular notice of dishonor to all the prior parties, making them liable on the instrument. Therefore, on the due date, all the prior parties along with the principal debtor would be liable to the holder in due course. If any of the party can make the payment and discharge him, and he can charge from the principal debtor in turn. What is meant by dishonor by non-payment? Once the instrument have been accepted for the payment, but on the date of payment, if the principal debtor fails to make the payment, in such case, instrument is said to be dishonored by non-payment. Then notice of dishonor is must to be given by the holder to the prior parties. If any of the prior party have died, it should be given to the legal representative. The prior parties become insolvent, it should be given to the liquidator. Only then they would be liable on the instrument. Only after taking the notice of dishonor, they would be liable. Without mentioning the notice of dishonor, they are not liable on the instrument. Okay, so these are the important points which you have to keep in mind. And sometimes the notice of dishonor is not necessary when the party is not found in case of unavoidable circumstances, and specifically that particular prior party have waived the right to receive the notice or dishonor. Okay, so these are the important points relating to the dishonor by non-acceptance, dishonor by non-payment, and notice of dishonor. Next one is dishonor of check. In what cases the check would be dishonored? The check is dishonored when the check is presented for payment by the payee or the holder of the check. If there are insufficient funds in the account of the drawer, then the banker would dishonor the check. Then the check would be bounced. This is also called as bouncing of the check. Therefore, it is very, very important to verify or check before issuing a check to the holder. The drawer should verify and check whether there are sufficient funds are maintained in that particular account or not. He should check whether the sufficient funds are maintained in his account or not. Okay, so in such particular case, when he draws the check, without verifying that sufficient funds, if he gives the check and check gets bounced or dishonored because of insufficiency of funds, in such cases the drawer is punishable with a punishment or imprisonment up to 2 years and fine twice the amount of the check, or both sometimes. So you should be very careful at the time of issuing the check. Okay, so these are very important provisions which we have seen in the Negotiable Instrument Act. In this particular act is important for practical, theoretical, as well as for the bids. Okay, so with this we will stop this particular concept of negotiable instrument, and we will go to the next area, that is the Indian Contract Act. Okay. So we will discuss briefly when Indian Contract Act, which is also important for your examination perspective from 8 to 10 marks. And the three important aspects are covered in the Indian Contract Act. What are three important contracts which are covered? Generally, you have seen this particular Contract Act in detail in your foundation, but here the special contracts are covered in your CA Inter syllabus. What are those special contracts? Contract of indemnity and guarantee, contract of bailment and pledge, and the contract of agency. These three are the special contracts. Indian Contract Act is also applicable to whole of India. This is also very important from the examination perspective. Companies Act is also applicable to whole of India. All these Indian Contract Act, Companies Act, NI Act, all these are central acts which are formulated in the Constitution of India. Okay, central acts which are applicable to whole of India. And in this particular contract, first we are going, I'll just briefly discuss, briefly tell you the basic foundations of this particular three special contracts. What is indemnity, what is contract of guarantee, what is bailment, agreement, what is pledge, and what is agency. Okay, indemnity. In case of indemnity, the contract of indemnity, where one party promises the other party to make good the loss suffered by other party, either by conduct of himself or conduct of any other third person. Okay, so in case of contract of indemnity, it generally discussed under section 124 of Indian Contract Act 1872, where one party promises to save the loss of other party or make good the loss of other party if that loss is because of the person or because of the conduct of that person or by conduct of any other party. The person who is making promise is called as an indemnifier. The person who is making promise to make good the loss is called as an indemnifier. The person whose loss is made good is called as the person to whom the promise is made is called as an indemnified or indemnity holder. Therefore, there are two parties in contract of indemnity. One is indemnifier, another one is indemnified or indemnity holder. Okay. In this particular case, I'll give you an example. Suppose I went to take a property for my office lease. Okay, I went to take lease for the for my office purpose. Okay, I asked for 10 years lease a building for which I would pay 1 lakh as rent every month. Okay, then I went and asked that particular owner of that particular building, so please let out your property for 10 years lease, and I would make a rental payment of 1 lakh every month. And I would also assure you that if any damages happen in this particular 10 years of time to your building, I will try to rectify them, and I also assure to maintain to give you back the building in a very good and proper condition. Okay, so here the person who is making promise to the owner of the building, the tenant who is making a promise to the owner of the building is called as an indemnifier, and that particular other person, the owner of the building, is called indemnity holder or indemnified. If any loss happened to the building during the course of 10 years period, it is the responsibility of the indemnifier and tenant to repay back to the owner of the building. Okay, another example. For example, if I have taken fire insurance for the stock, the insurance company which is giving an insurance, which is coming into an insurance contract with that particular company against for protection of their stock from fire, that insurance company is called as an indemnifier, and the persons or individuals or the company would be called as an indemnity holder, because the fire insurance company is giving a protection or giving promise that it would cover the loss at the time of the accident. Okay, so that is called as an indemnity contract. Here in this particular case of indemnity contract, it is this any loss caused by only by the indemnifier, that is the promisor himself, or by any other person would only be covered. Loss caused by the promisee himself or by the act of gods are not covered in the contract of indemnity. For example, if any loss caused because of floods or earthquakes, tsunamis, where the losses happen to the stock, is not covered in indemnity contract, and it is because of the act of God. Okay, so death of the promisee, in such cases, this is also an act of God. In such cases, it is not covered under the contract of indemnity. So these are it. The contract of indemnity might be express or implied, and here all the essential elements of a contract are also applicable. Here the essential elements would be like the contract is made between the parties for consideration, and the object of the contract should be legal and lawful, and all other there should be an acceptance. All these things are also applicable even for the indemnity contract. Suppose if A asked B and asked A was totally I'm like enemy of C, and A was not happy with C's deeds, so A asked B, his friend, to go and beat C, for which A promised B that he would indemnify B if he got any damage because of C. Then later on, when B and C are fighting, B was totally like he was wounded and he was hospitalized, and in such case the B asked for the hospital expenses and A failed to make the payment. Now B cannot go to the police station and file a complaint, or go to a court file a complaint against A, because that particular act is illegal and it is unlawful. Beating somebody, and for such contracts, if there is any indemnity contract between an indemnifier and indemnity holder, those are not valid, and they would also be not accepted in the court of law. Okay, so these are the basic things related to a contract of indemnity. Now, what are the indemnity? What are the benefits? What the indemnity holder can recover from the promisor or indemnifier? Damages in a suit, cost of suit, and sum which is used to pay at the time of compromising or settlement of a suit. These three things he can recover from the promisor. Next, contract of guarantee. This contract, first let me tell you, contract of guarantee is defined under section 126 of the Indian Contract Act 1872. Contract of guarantee, meaning of contract of guarantee is where one party promises or gives a surety or assurance to other party regarding the payment of money. Okay, that is generally between contract of guarantee takes place between three persons, that is principal debtor, creditor, and surety holder. When principal debtor approaches the creditor asking him to give some amount of loan, a person's guarantee or assurance for the loan amount taken by you. In such cases, principal debtor approaches a financially sound person or his friend or his father for the purpose of giving guarantee. Then that other person who's surety holder, who gives surety on the principal debtors to the creditor, this particular contract between all of them three will be called as a contract of guarantee, where there are three parties: principal debtor, creditor, and surety holder. The surety holder give assurance to the creditor saying that if principal debtor fails to make the payment, I am liable, or I would make payment to the creditor. Who would give this assurance? Surety holder would give an assurance. Okay. For example, A obtains a housing loan from a bank, and B promises to pay the bank in the event if A fails to repay back the money to the bank. In this particular case, A is a principal debtor, bank is the creditor, and B, his friend, is the surety holder. Okay, so this is a generally in case of indemnity there are two parties, indemnifier and indemnity holder. In case of guarantee there are three parties. Who are those three parties? Principal debtor, creditor, and a surety holder. Indemnity contract is a speculative contract which depends on happening of some future event, but in case of guarantee it is a contract which will take place only in case of when the amount is borrowed or giving an assurance on specific person. In such cases, a contract of guarantee comes into an existence, where the debtor's liability is primary and surety's liability is secondary in case of contract of guarantee. In case of contract of indemnity, the indemnifier's liability is primary in this particular case. In the contract of guarantee, there are three contracts between debtor and creditor, between debtor and surety holder, between the surety holder and the creditor. However, in case of contract of indemnity, there are only one contract between the indemnifier and the indemnity holder. Okay, so these are the basic difference between contract of indemnity and contract of guarantee. Next, in case of contract of guarantee, there are two types. Examples: there are two types of contracts of guarantee, basing on nature of payment, basing on effective time of payment. Okay, so regarding when it comes to the effective time of payment, the guarantee is for if it is given for an existing debt of obligation, it is called retrospective guarantee. When it is given for the future debt, it is called as a prospective guarantee. But when it's come to the payment, it's very important: specific guarantee and continuing guarantee. I will tell you major differences between what is specific guarantee and what is continuing guarantee. Okay. In case of nature of payment, specific guarantee, this guarantee is given by a surety holder only for a single transaction and is an irrevocable guarantee. The surety holder cannot revoke this contract in between. He cannot revoke his guarantee in between in case of specific guarantee, which is given only for one particular debt. That particular debt will be discharged only when the principal debtor makes payment to the creditor. Then surety holder will be discharged from the liability. Therefore, it is irrevocable. But whereas in case of a continuing guarantee, the guarantee is given for series of transactions. The liability in this particular case, the liability of that particular surety holder can be revoked. Can be revoked in between. Then transactions after the revocation will not. The surety holder will not be liable for such transactions. Okay. Guarantee on a person. If a guarantee is given on the conduct of a person or honesty who is employed in an organization, that is called as a fidelity guarantee. For example, if one of the ABC organization have asked me that we need one genuine person as a cashier for the organization, if I suggest my brother as a employee for that organization, it means that indirectly I'm giving assurance that my brother would deal with that particular transactions well, and he would not cause any any fraud to the company, and I am giving the guarantee that is called as fidelity guarantee on a specific person. Okay. Next, continuing guarantee. In case of, for example, in case of continuing guarantee, A guaranteed payment to B. A told B, who is a dealer of tea, supplying tea, for an amount of 10,000 rupees, that he would supply tea to C. Okay, so A is giving guarantee to B, who is a shopkeeper, who is a creator, asking him up to 10,000, what all tea you supply, how much amount of tea you supply to Mr. C, I would be liable as a surety holder if B fails to make the payment. Then afterwards, B supplies C with a T first initially until 10,000 value, B supplied to C, for which the B had made the payment. Afterwards, B supplied C with a T value of 20,000, where C fails to make the payment. Therefore, in such cases, A would be liable only to 10,000 because he had made an express agreement saying that his liability only to the extent of 10,000. Okay, so continuing guarantee is revocable in between and before the completion of the contract by through express revocation, or by death of the surety holder, or by material alteration, or by impairment of surety's remedy, innovation by substituting a new contract in place of old contract, or any arrangement between principal, debtor, and creditor, or loss of security. In such cases, the continuing guarantee would be revoked. Okay, so what are the rights of surety holder? The surety holder have rights against the principal debtor, against his co-sureties, against the creditor. These are the rights. Rights against principal debtor is, once the surety have discharged the payment on behalf of the principal debtor, he will step into the shoes of the creditor, and he can claim the entire amount from the principal debtor as per the agreement. Against the co-sureties, if there are co-sureties, if one surety makes the payment on behalf of all to the creditor, then he can claim the values from other surety holders according to their agreement. And against the creditor, the surety holder, once he makes the payment, he can take the security which is kept with the creditor as a security for the purpose of amount given, and he will enter into the shoes of the creditor. Okay, so these are the rights of the surety holder. Discharge of surety holder. In the following three situations, the surety holder will discharge, and the surety holder will be no more liable on to the contract. In the case of revocation of the contract of continuing guarantee, in case of invalidation of contract of guarantee, and by the conduct of the creditor. In case of revocation of contract of guarantee, by if a notice is given by the surety holder, after that notice, if any transaction takes place, the surety holder is not responsible. By the death of the surety holder, and by novation, it means that in place of old contract, the new contract is been substituted. And by invalidation of contracts, in case of invalidation, there is misrepresentation, concealment, failure of the co-surety joining as a surety holder, and failure of consideration. In such cases, the surety holder will be discharged. And also by the conduct of creditor, it means that variation of the terms of contract, or releasing of the creditor himself releases the principal debtor, automatically surety holder will be discharged, because the liability between the principal debtor and creditor is primary, not between the creditor and the surety holder. If the principal debtor is released, automatically surety holder will also be discharged from the contract. Okay, so these are the cases where the surety holder will be discharged. And next important contract in the Indian Contract Act. Until now, we have seen what is a contract of indemnity, contract of guarantee. In contract of indemnity, there are two parties. In contract of guarantee, there are three parties. In contract of indemnity, the persons are called indemnifier and indemnity holder, and there is a single contract. In contract of guarantee, there is principal debtor, creditor, and surety holder. There are three contracts among them. Okay, so these are the basic things which we have seen in the contract of indemnity and guarantee. Next comes to bailment. Bailment is under section 148. In case of a bailment, only possession of goods are transferred from one person to other person, but not the ownership in goods is transferred. Okay, so in case of a bailment, what is transferred? Only possession of goods are transferred from one person to another person for some purpose or for some conditions. Once a purpose or condition is over, the goods have to be returned back compulsorily. The person who is transferring the goods is called as a bailer. The person to whom the goods are transferred is called as a bailee. Okay, there are two parties in contract of bailment, bailer and bailee. The person who is transferring is called bailer, and the person to whom the goods are transferred is called as a bailee. It might be for consideration, or it might not be for a consideration. For example, I will tell you. Suppose if I gave my car to my friend asking her to go and bring this kids from school, it means that I am giving my car as a bailer. I'm just giving my car as a bailer to the bailee for that particular day or for that particular work. Asking her, since I'm having an urgent work, I'm asking my friend to bring the children from school. Okay, so once after she brings the children from school, she'll give back my car to myself. Okay, so in that particular case, I am the bailer, she is the bailee, and for one purpose I have given my car to that particular person. And this is a non-gratuitous because there is no consideration with bailer and bailee. It is no, and it is gratuitous. Sorry, non-gratuitous. It is gratuitous. It is doing for free without any consideration. Suppose if I went to a tailor shop and given my clothes for purpose of stitching, then in such case I need to give a consideration for the tailor once I get back my cloth stitched. Okay, into a salwar suit or into any dress. And that particular tailor, he uses his skill and talent for the purpose of making that particular material cloth into a dress. Okay, so for that particular services rendered by the tailor, I will give a consideration. This is a non-gratuitous bailment. Okay, so when the goods are delivered from one person to other person, the person delivering is called as a bailer, and the person to whom the goods are delivered is called as a bailee. And it is of two types, gratuitous and non-gratuitous bailment. The essentials of valid bailment are there should be a contract between, it might be expressed or implied contract, and there should be delivery of goods, and the goods should be delivered for some purpose. Okay, and once the tailor stitches the dress into my material into the dress, what he will do, he will give back my dress. Until and unless until I pay those tailoring charges to that particular other person, he keeps the goods with himself, or he keeps the dress with himself. That is called as a particular lien. What is called tailor is having particular lien on the particular goods. Once I pay the charges to him, he give back my dress. Okay, so this is about the essential elements of a valid bailment. I have already told you gratuitous bailment, non-gratuitous bailment. If a contract of bailment where there is no consideration between bailer and bailee, it is gratuitous bailment. When there is consideration between the bailer and bailee, it is called as a non-gratuitous bailment. Okay. Duties of bailer. What are the duties of bailer? It is necessary for the bailer to pay all the necessary expenses, which, say, suppose if I'm giving my car to the other person, I should ensure that there is proper petrol. Expenses related to the petrol should be borne by the bailer. Okay. In case of non-gratuitous bailment, the bailer will the bailer should also bear the extraordinary expenses. Okay. And the bailer should receive back the goods after the purpose or of the completion of the particular work. And if the bailer knows some defaults in that particular goods which is being transferred, he should specifically mention them to the bailee. Okay, otherwise he should indemnify the bailee for premature termination of the contract. So these are the duties of the bailee. Then what's the duties of the bailer? Now what are the duties of the bailee? The bailee is to take proper care of the goods bailed to him, not to mix the goods bailed to him with his own goods, compensate for damage caused to the goods, return the increase in the goods, and return the goods and also return the increase. If we get any, once the particular good is given, and further if we get any additional thing during the stay of goods with him, he should also give that particular increase in the goods. So these are the duties of bailer and bailee. Then what are the rights of the bailer? To terminate the bailment. The only gratuitous bailment can be terminated in between the demand for return of goods, to claim the increase in goods, and to claim for the compensation. Okay. Now, I have already told you what is particular lien and general lien. Particular lien is nothing but it is a right to retain the goods on which the charges have to be paid. For example, tailor, he will retain those goods until you pay charges to him and get back your trust. General lien is nothing but in general, all the goods relating to that particular bailer will be kept until proper payment is made. For example, banks. Okay. Examples like bankers, factors, wharfingers, attorneys, they will have the general lien over the goods of the bailer. Okay. Finder of lost goods. Finder of lost goods will also have a possession until his expenses are paid. He have right to recover the reward. And if suppose after finding the goods and be handing over it to the owner of the goods, and if he incurs some expenses, if that expenses are not repaid to the finder of the lost goods, he have right to sell the property, and he can claim the lawful charges of 2/3 or more of the value of the particular article found. Okay, so these are the provisions which are available for the finder reminders of lost goods. Termination of bailment. Bailment will terminate after an expiry of fixed period, after fulfillment of purpose, or by unauthorized acts of the goods bailed by the bailee, termination by gratuitous bailment, or by death of the bailee, the bailment will be terminated. Okay, so these are the few important aspects relating to the bailment and pledge. Now next come to the very important topic of Indian Contract Act, nature of agency. In this particular contract of agency, there are two parties. See, contract of indemnity, two parties; contract of guarantee, three parties; contract of bailment, two parties; and in case of pledge also two parties. In case of pledge, here the goods are, in case of bailment, the goods are delivered for some purpose. After the purpose is completed, goods are returned back to the I mean to say to the bailer. But in case of a pledge, the goods are pledged or the goods are transferred for the as a security for the amount borrowed from the financial or from the pledgee. Okay, once because of the amount borrowed for that particular case, the goods are transferred as a security. But in case of bailment, the goods are transferred for some purpose. In case of agency, now we have two parties, principal and an agent. And if a part in this particular case, if principal, if his business is more and if he can't do all work on his own, in such case he appoints an agent to do work on his behalf. Therefore, the agent should act according to the directions of the principal. Okay, there is a relationship between the agent and the principal, and he does work on behalf of the principal. Okay, there are two parties, agent and principal. How the agency is created? By operation of law, by express agreement, by implied contract, by estoppel, by holding out, and by ratification. By ratification means what? By approving. The meaning of ratification is approving. So this is also very important aspects in the contract of agency, where agency is created by operation of law. By operation of law means sometimes, for example, in case of a partnership firm, partners are acting as a agents for the firm by operation of law. In case of a company's act, the board of directors are acting as an agent for the company for performing the duties of the company on behalf of the company, even though there is no express agreement between the company and the board of directors. Next, by express agreement means they will write a power of attorney will be drafted by the principal debtor, appointing an agent and giving him all power to conduct the business on behalf of the principal debtor. And next, by estoppel, by holding out and necessary. These are few other things. In case of necessary means in case of emergency, if any property belonging to other, for example, a lorry driver, when he's traveling there, when he's taking the perishable goods from one place to another place, in between, if there is sudden floods, the lorry driver have right to completely sell away the product so that at least some amount would be retained to the owner. In such cases, he would become an agent by necessary, husband and wife. So the relationship between them is also agents by necessary. Okay, so these are few examples for agency, how the agency will have been created. Okay, now next important topic is what is ratification and what are the limitations for the doctrine of ratification, and who are generally kinds of agent based on nature of work. There are mercantile agents and non-mercantile agents. Mercantile agents examples: bankers, factors, auctioneers, brokers, commission agent. Non-mercantile agents are like solicitors, attorneys, insurance agent. These are non-mercantile agents who work in their professional capacity, who are not commercial agents, mercantile agents. Okay, next one is sub-agent and substitute agent. This is also very important examination theoretical question. Sub-agent is a person who is acting or who is under the when the original agent who will appoint another person for his work or for sharing of his work, he is called as a sub-agent. But whereas substituted agent means in this particular case, for when a principal entrusts a work of auctioning or doing some work, some additional work to the agent, then agent, instead of doing that particular work by himself, he will appoint another person who is called as a substituted agent. Okay, so these are general differences between sub-agent and substitute agent. You can go through them in detail, which is important from examination perspective. Duties of agent are to take reasonable care and to work according to the directions of the principal, and not to make any secret profits, and to try to not to disclose the information of the business with the outsiders. So rights of agent are right for remuneration, right to recover expenses, and right to recover the losses. Termination of agencies. The agency can be terminated terminated by act of parties and by operation of law. By act of parties, as per the agreement, after specific period of time, the agency will be terminated, or by revocation by the principal, or by renunciation by the agent. Or agent, if he doesn't like, he would give an intimation to the principal and he would come out of that particular contract. And by operation of law means after completion of that particular business, then after performance of that particular duty, or after expiry of fixed period of time, or by any death of the principal and agent, the contract will come to an end. In this way, the contract of agency would be terminated. Okay, so these are few important aspects in case of contract of agency. So until now we have seen contract of indemnity, contract of guarantee, contract of bailment, and contract of agency. So with this I will stop today's session, and this is general, since it's a rapid revision, we have seen the basic important things of different contracts, but this is not sufficient, friends. You need to go everything in detail. Please try to refer the suggested answers of the previous years and try to relate your concepts to them and write exams properly and carefully, and especially when it comes to practical questions and direct questions, please try to focus on the concepts well, and try to write these theoretical questions in point wise, and try to avoid writing paragraphs. And practical questions, try to write provision well, provision, analysis, and conclusion in that particular pattern which I have already initially told you. And please try to prepare well. All the best for your exams. Thank you so much for giving me this opportunity. See you next time. Take care. Bye.